Yesterday, I wrote a blog about something that I observed because when I sit down to write a new blog, I do a lot of research. I go over a bunch of RRGs, and we have a bunch of RRGs, predefined groups on the RRG page on StockCharts.com. One of these groups is an RRG that is filled with international stock market indexes, and that's the one that you see here on this graph, and I have it highlighted here. The groups are, by the way, are here. When I went over it, I noticed that the S&P 500 is inside leading, and it's actually looking pretty good from an RRG point of view. It's actually looking pretty good. Just turned around, penetrated the leading quadrant, still at a strong RRG heading, but for some reason it didn't feel okay. It didn't feel like it didn't resonate with my view of the markets, and that has to do with my, let's say, longer term view of the U.S. market, and I base that off of the monthly chart of the S&P 500, and let me make that a live graph here, because what I'm looking at is this is the monthly bar chart, and we clearly failed at that previous high. I mean, the rhythm of higher lows is still intact, but we have a problem here in this 2900, 2950 area. And when I bring in I don't use a lot of indicators, but for just price charts, I'd like to plot an RSI and a MACD, just for trends and overbought, oversold, and divergences. And what I see here is a super strong negative divergence between the price chart and the monthly RSI. Now, I mean, if it's on a monthly RSI, I think it has an impact. It's a serious signal. Same for the MACD. I mean, the MACD rolled over on a monthly basis a couple of months ago, and it did not reverse back yet. You see that MACD line is still below the trigger, and the MACD line is already rolling back down. So that's still in a negative state. And then what I really don't like is that negative divergence on a monthly basis here, with that top failing. So this is my bigger picture for the U.S. market, and it just doesn't come across as super strong. And the problem is that the downside is still protected, but that trend line is around 2,400, and the upside is 2,950. So we got like 100 something points on the upside, but we got like couple of 300-400 points on the downside. So that's a risk reward that I really don't like, and that I had to match that with the fact that the S&P went into the leading quadrant. So I had to think about it, and what it actually is telling you is that the S&P is in a relative uptrend versus pretty much this whole list of international stock market indexes. And it's what I picked up from your talk earlier, Tom, that you said, the S&P is outperforming. It means that the US economy is stronger than the rest of the world, and that's exactly what it is. But what I wanted to know is, does that actually mean that the S&P is going to go higher? And if you work RRG on stock charts, you have an option to go back like 10 years. I mean, it's standard, it loads 1 year of data. But if you want to do some historical searching, you can actually go back 10 years of data. And if you really want it, you can actually animate it. I played it. Animating 10 years is going to take like a minute and a half, or 2 minutes. So I'm not going to do that. But you can do that when you want it on your own system. But in the blog, I've highlighted a few snapshots where I noticed that when the S&P is moving into the leading quadrant, so either moving towards and into, very often it seems to concur with a high and or a decline in the market. So this is April 2010. You see that the S&P is moving inside that leading quadrant, well into it, moving to the right. It's right at the moment where the market starts to roll over. If we go to April 2011, it's at the top of the market, but you see that in the run up to that, the S&P outperformed. And it looks like as if it's weakening, But we all know that the strongest moves come when it rotates on the right-hand side of the graph, and that's exactly what happened during this decline. The S&P rotated all the way on the right-hand side. It never hit the lagging quadrant. So again, this is a situation where the market, and by the way, the market here is the Dow Jones Global Index. So that's the world stock market index. In 2014, again, we're running up to a high, and you see a rotation on the right-hand side of the S&P 500, the US market. If you go into June 2015, we are in a high situation, and we're rolling back up towards that. And we go into this big decline, the biggest decline that we had for a long time in this all the way up rally. January 2018 is where the market hits a high, and the S&P penetrated the leading quadrant and is still moving to the right, lost a little bit of momentum, still moving to the right. And at the moment, right now, we are with the S&P well into the leading quadrant. And are we making a new high in world markets? I don't know. We cannot really tell for sure. But with this knowledge and this observation, I'd like to be very careful with stock markets in general, and the S&P for that reason as well, because the S&P can be in the leading quadrant, but still going down. The only thing that this tells you is that the S&P will go down less than the rest of the market. So I tried to find a rationale for that, and my take is that investors, international investors, maybe see the US as a safe haven. So, when stock markets around the world are having a hard time, let's move to the US, let's move to US large caps, because they'll be doing pretty good. Just like you will see that during bull markets, small caps tend to outperform, they tend to do really well, and large caps tend to underperform. But when the general market starts to turn down, large caps start to improve and outperform small caps, because small caps are inherently more risky, so people move to large cap as some sort of a safe bet. So this is what I wanted to share with you from a let's say international perspective, and what it actually means when you see the S&P 500 moving into the leading quadrant, because it doesn't necessarily mean good news for the market as a whole. Now, when I wrote that piece yesterday, today on Thursdays I write the Don't Ignore This Chart blog, and one of the other tales that caught my attention was China, SSEC, the Shanghai stock market. It is on the RRG. Let me highlight it for you. In terms of RS ratio, the strongest country, strongest index on this universe. It's the highest in terms of relative strength ratio. So it's a very strong relative trend versus the global stock market. But we see this strong hook going down. Now the question is this the end of the uptrend, or will we see, and let me bring up that the ITC of today, because you see what I've cheekingly annotated that stock with a possible move, because we're in this very strong move. We moved into weakening, but we're very far away from the benchmark and from the 100 level. So there is a very good chance that we will see a rotation back up once this sort of correction is over. And the chart that I am looking at to back that up is this one here. And this is the SSEC index. And what I see here is this is what's caused that super strong move that we saw during the first, let's say, 5 months of this year. And we're coming off strongly off of these highs right now. And this is a 50% retracement level. Now, I don't use these retracement levels very often. I don't pay too much attention to them. But in this case, that 50% retracement level seems to coincide with two support levels that I'm watching. That's the 2800 level, which is a level that has been respected as a sort of area of shift in supply and demand a few times in the past, so that means something. That's around 2,800, and around 2,700. That's a little bit more pronounced and a little bit more recent. We see this as a support level here. We had this double bottom and that break. So with this move coming out of that downtrend, this is pretty much the first serious corrective move of this rally at this 50% retracement level and these two support levels. So I'd like to see this as some sort of a buying opportunity and a buying level in that 2,800 area. Now, if we shift to that relative strength, we see that the downtrend in relative strength versus the S&P 500 has turned around, and it's starting to show this. It's still shallow, but series of higher lows, which is good. And if we translate that to the RRG lines, you see that during this whole downtrend here, the RRG lines have been camping pretty much below the 100 level with two small exceptions. It's now above it, seriously above it, and in its first corrective move. So if we can hold up, where is it? This rotation here, then China might actually be an opportunity going forward when that 2,800 support level in the Chinese market index holds up. One thing I need to emphasize here, and I think is very important, it's maybe one of my things that I talk about too much and people get bored, but when people, and we can talk about that in the poll, because the poll is asking you whether you have interests outside of the US. Now, I know that a lot of people outside the US, or a lot of American investors, invest outside of the US via ETFs. But, and it's a good thing, I mean, that's absolutely the way to do it. When you do your analysis on these international markets, and you may have noticed that the RRG that I use and the charts that I use are using the actual indexes. So this is the index as it is traded in Shanghai. This is not an ETF. And the reason for that is that ETFs quoted in US dollars can look completely different from what's actually happening in that local market. Now, this is the Shanghai stock market, and here is the ETF of that Shanghai stock market. Now, let me put those side by side for you, and you can see what I mean. So here is that ETF, and here is that Shanghai market. So these are the same graphs. Look at that. This high in 2015 is way up there. Look where that ETF was. And look where that peak in 2018, which corresponds with this one, had a. So the ETF is way higher than the peak in 2015 than it was in the local market. The reason why that is because this one here, that's the S&P China ETF Spider, is quoted in US dollars. And the difference that you see is the exchange rate between the US dollar and the Chinese yuan or renminbi, to the Chinese currency. So for me, I'd like to do the analysis on the indexes. So I'd like to look at the chart of the Shanghai Composite Index. I like to look at the RRG that shows, you will see here, they're all dollar symbols, so they're all in their local currencies or their local index levels. And then when you start actually translating that into a position, then you move to some form of ETF or an instrument that is actually tradable for you, and that you can trade from your US brokerage account, et cetera, Just be aware that you are inheriting a currency risk when you do that. Okay, so from an international point of view, US market starts to outperform. I don't think that's particularly strong for markets in general. The Chinese market is way out to the right. It's the strongest market still in terms of relative strength, and it looks to be going through some sort of a corrective move and might offer new buying opportunities in coming weeks. So that's the take for the international markets. Let me get you the view of US sectors. Where did I stick that? So here is my RRG for US sectors. And I need to bring up my, go away, my dashboard and my chart list. And here is my weekly ETFs, and let's bring up the summary so we can have them side by side. Materials, symbol here. Inside lagging and at a weak RRG heading. If we translate that to the chart, I think that we clearly broke that support line, and what's even more important is we broke below this uptrend line, and we're already below this previous low. You see that the RS ratio line rolled over below 100. For me, this one looks ready to go lower on a relative basis, and there is plenty of downside on the price chart to accommodate that relative weakness. So this one is in my weak bucket. This is an underperform. I'd like to stay away from this from an absolute point of view. If we go to communications, that is a completely different story. It's almost moving in the opposite direction. It's inside leading. It's at a strong RRG heading. Still moving there higher in that leading quadrant. If we look at the price chart, we see it failing at that 51 resistance area, that previous high that was set in the middle of 2018. But we are sort of breaking out of this range on the relative strength line. The RRG lines are moving higher in tandem at the same rate, so that causes that strong RRG heading. So, you know, XLC Communication Services is one of the sectors that I think that, especially from a relative point of view, will have some sort of positiveness in store for us in coming weeks, even despite the fact that the price might go a little bit lower. Energy, very, very weak. If you see how that rotated, you see that was improving, but before it was even close to getting into the leading quadrant, it already started to roll over, and it's now on a track almost vertically down and inside the lagging quadrant. That's what we know is a very weak rotation. And if we put that on the price chart, you see that we have some sort of a similar situation where we broke the uptrend, tested the old support line as resistance, and we're now heavily moving down. And today is again a weak day for the energy sector, and we broke below this previous low in relative strength. RS ratio is rolling over way below 100. So that's one for the negative side of the RRG. That's an underperformer. For the financials, different story, moving from leading into improving. Question is, how sustainable is that move? You see that it has a short tail, so there is not a lot of power behind that move, and the move is pretty much only vertical. It's only gaining on that RS momentum scale, and it's not picking up a lot of relative strength. And if we study that on the price chart, we see that series of lower highs and lower lows on the relative line is still there. It's still, comfortably below the 100 level in terms of RS ratio. That's what you can see here. I don't think that it'll be able to push beyond this resistance or relative strength. And if you look at the price chart, it just touched that falling resistance line, and it looks as if it's completing this rising wedge pattern, which is not a very good sign. So energy remains, financials remain on the weak side of the spectrum as well. This is not a sector that I expect to outperforming going forward. Industrials, inside weakening, but very close to crossing over into the lagging quadrant, and I can see that happening with this big wedge being executed on the price chart. A triple top or 3 tries to break above that level didn't work. 72 provides some sort of a support, but more importantly, This support and relative strength seems to be breaking. There's a little bit of room left before we hit this previous low in relative strength, but those lines are rolling over. And this one is so close to that 100 level on the RS ratio that I expect further weakness going ahead and more underperformance for the industrials sector. Technology, we all love technology, or maybe I should say we all love technology, because it's rolling over. It's the strongest in terms of relative strength, but it's now losing momentum. So the question is, how strong is this loss of momentum going to be, and how far is it going to set us back? It's a little bit like the Chinese rotation on the international RRG that we just saw. What I don't like is that we broke above this previous high and are now breaking back below it. That's usually not a very strong sign. And it looks as if the same thing is happening with that break in relative strength that's now breaking back below. I am not a buyer of technology at this point in time. I'd be very careful, but it's too early to call it a strong underperformer yet. But I'd be very, very careful and maybe look to unload some of the technology holdings in my portfolio because of this rotation. So it's in the neutral camp, so to say, neutral to weak. Staples. I do like staples. Why? Because it's rotating strongly. It's got a strong RRG heading. It's in improving, close enough to the leading quadrant to be able to pull through and continue into the leading quadrant. But really, because it just broke to new highs and it is still holding up above those previous highs that are now acting as support. So here we have a sector that is well protected on the downside and has got a ton of upside potential in terms of price. And you see that this longer term falling trend line, downtrend in relative strength is turning around. We see the first higher low coming in. If this continues and those RRG lines will push above 100, there is a bright future for the staples sector. And as we all know, and what Tom pointed out in his part, is that when staples are doing well, that's usually not the best thing for the market. Real estate. Interest rate yield sensitive, looking pretty good. We see a rotation, a curling up inside the weakening quadrant, starting to move higher, picking up rotation there. So that's good. And if we can push above this previous high, supported by a break above previous highs in relative strength, this could actually be one of your stronger sectors going forward. So keep an eye on this one as a safe haven or an outperformer. Utilities, traditionally a defensive sector, not yet visible on the RRG, although it is inside lagging, but starting to pick up quite rapidly right now. And what I do like is the fact that it seems to be breaking out of this flag pattern on the price chart. It's confirming its uptrend. It's at new highs, which is very strong, just like staples. So you got utilities and staples breaking to new highs. And it looks as if the breakout that we saw in Q3 in 2018 is holding up, and we're now ready to move to new relative highs with that rotation pushing higher. It's a little bit early here. It's a little bit early for utilities. Staples are further down the line, and so is real estate. But this one is definitely one to keep an eye on, especially in the back of our minds. The expected weakness, or at least my expected weakness, for the US market as a whole, then usually utilities will start to shine and they're ready to rotate back up. 2 more to go, and then I think I'm doing pretty good on time here. This is healthcare. I don't know what's happening there, but this one is very, very weak over the last 8-9 months out of this high. It was super strong in 2018, and then it started to deteriorate, and we see a little bounce here, and it looks impressive, but if you look at the RRG, it's still losing. It's still moving to the left on the RS ratio scale. It's just picking up a little bit of momentum. I mean, as the song goes, that don't impress me much. It is, from a relative point of view, it's the weakest sector in the market. From a price point of view, it's inside a consolidation pattern. Maybe you want to call it a triangle. I think it's way too big for a triangle, but it's, the highs are getting lower. The lows are getting higher. It's going into that cone, sideways at best. I'd be very. We've got way more up. The way I look at this stuff is, I'm not going to make up my mind whether it's going to go up or down, because we've got enough areas of the market and enough stocks in the market to go if we don't know what's happening. And this is typically one of these sectors that, it looks very weak to me. Could go either way. I'd like to look for opportunities elsewhere. Just stay away from that healthcare sector. And then finally, we got discretionary, which is the opposite of staples almost, but they're still moving in the same direction. What I see here, this was and still is probably a strong sector in terms of relative strength, because we are at a high reading. But what you see here, it's got a very short tail, and what you see is that those weekly observations over the last 5 weeks are getting closer to each other. And I've discussed this previously here on Market Watchers Live, that when these distances are getting closer together, the odds for a rotation are getting bigger, because it's easier for that tail to roll over. And that's what seems to be happening right here. Look at that price chart. We broke to new highs, broke back below that support level. This resistance level should act as support. It didn't do that, so it rejected that support level, and that's usually not a good sign. So everybody who bought on this breakout is now probably looking to get out, which is not a good thing. And the same thing goes for that relative strength breakout. That's not holding up. And with this rotation here, it's not a super sell for me, but it is definitely a sign that weakening is ongoing. And I'd like to see a new higher low to get back into place before getting very enthusiastic about this discretionary sector going forward. Summing this all up, it means that I got, on the positive side, I got communication services, staples, and real estate, with utilities neutral to positive. And then I've got very weak sectors in materials, energy, financials, industrials, discretionary sort of rolling over, technology, at least temporarily rolling over, and healthcare seem to have had his run, but very, very uncertain. So all in all, not too strong about the market in general, and from a sector point of view, more gearing towards a defensive holdings in my portfolio. That's about it, Tom.
All right. It is good to have you